Welcome back in YouTube. Today we are going to talk about hymns. This has been requested by a lot of individuals and I'm just getting around to it today. Boy, has this one fallen off here, going from a 52-week high of $11 down to $2.72. Is this company going out of business? Not really, but we're going to go over the pros and cons of what's going on with hymns. So let's get into it. Now, Hims is a telehealth company that was really making its money from erectile dysfunction and hair loss, but they're starting to expand outwards and their numbers are starting to get pretty mind-blowing. This company has sold off with a lot of your other growth companies for good reason, guys. Let's call it what it is. They're unprofitable, and being unprofitable in this market is just unacceptable. But with that being said, is there opportunity for this company? Let's dive in a little bit deeper. Whether you're looking for sexual health, hair, skin, mental health, everyday health, they got a little bit of everything and they're expanding their line every single day, it seems. And with them being really focused on male health, they're starting to switch this around and start putting money towards female health. When we look at the analyst expectation, we can see here they have an average buy rating with a low of $4 all the way up to a high of $10.05. Now, this is a company who is a true growth company, guys. They are growing top line. Not only are they growing top line, we're going to get into their quarterly reports. I'm going to show you some things that are pretty impressive about this company. Let's start out with this top line revenue growth. Talk about impressive. In 2019, $82 million. 2020, $148 million. In 2021, $271 million in revenue, and in the trailing 12 month, guys, they're already at $320 million in revenue. So first thing I want to bring to your attention is going to be their cash position. Now, why is this important? Well, this company is unprofitable. Their burn rate has been anywhere between 20 to 30 million per year, and we can see here the cash position is definitely something you want to keep an eye on. It is coming down, but plenty of cash here for the next few years, in my personal opinion. So when we look over year-over-year revenue growth, they were at 52 million a year ago, and the recent quarter they have grown to 101 million in revenue. So there's no question that this company is growing. That is an absolutely strong quarter for the company. Venture capitalists put a valuation of $1 billion onto this company, and when they SPAC'd, they had about a $1.6 billion valuation. Currently, where it is trading today, it has a $987 million valuation, which means two things. You are buying it well below the SPAC deal, and you're buying it below what venture capitalists raised for. So both valuations are currently under what the SPAC deal was and what venture capitalists put in for the valuation. Now, obviously, that doesn't mean you're getting a deal if the company is going to go bankrupt, but I don't think that's the case for Hims. Another thing I want to point out to you, ladies and gentlemen, is they are putting some shares on the market here. Their share balance was at 191 million shares as of last year, and now is at almost 206 million shares. So roughly 15 million shares were put on the market here, and while that's not a huge amount of shares in over a year, considering where the stock price is, this is the real problem that Hims has. As a growth company nowadays, it is really hard to raise capital when interest rates are rising. One of the few ways that these growth companies raise capital, unfortunately, is going to be through share dilution. And when a company's stocks are trading at such low price per share, the more they have to dilute to get the capital they're trying to get, which is a problem for individual shareholders. So these are the red flags that I'm seeing, guys. The cash position is coming down, and we're starting to see that the share price could affect cash raises in the future. So we want to see some stabilization within the share price. That'll help them to raise the amount of capital that they need without diluting you as a shareholder as much. And when they break down their online revenue versus their wholesale revenue, we can see that online revenue is growing strong. And that is what you want to see. That's where the margin expansion is coming from, is the online revenue. When we compare gross margins to their competitors, they're sitting at almost 75%, while the sector median is at 55%. So they are getting an advantage with their margins. Now we have to start seeing those margins come through and be profitable, guys. So when we look at their growth, It's pretty impressive, guys. Online grew by 86% year over year. As we can see here, one of the most impressive things about Hims is their subscriptions has grown 82% to 710,000 active subscribers on their platform. That is pretty impressive, and that is definitely worth something. So guys, personally, I was very interested in Hims when they were talking about profitability by the end of this year, by the end of 2022. And what happened was they still maintained some positivity on possible profitability. Here's where I'm starting to get a little bit nervous and why I'm going to wait for the next quarterly report is they are doubling down on hers, which to me means more spending and makes me a little bit nervous, especially when I think about where their stock price is. So I'm going to run a valuation on Hims and get an idea of what I think the stock should be worth. It is very, very unclear now to me when are they going to be profitable. I think because they were going to be profitable this year, I'm going to extend out profitability for another 2 years, saying that they're probably going to spend a lot more on doubling down on the Hers brand, which means that they're probably not going to see profitability in the near future. You topple that with the inflation costs that have been going on for a lot of companies. I think they're probably dealing with both inflation and freight costs. So I'm going to be very cautious in the way I project out these type of earnings here. Now, guys, I want you to understand that this is pretty much considered a penny stock at these prices, which means that people don't have a lot of faith in this company becoming profitable. With that being said, I do think they have a decent amount of cash for their burn run rate, and I do think that they're building out their platform pretty strong, more than the actual market is giving them credit for, which means there could be a heck of an opportunity here. We do have a price target of around $6.41, giving it roughly a 33% upside here. Major problem I have is the forecast for the company. They're not expected to be profitable for a very long time. They're going out as far as 2026 for them still not being profitable, which is definitely a red flag. But is this right? I have a hard time believing this, considering that their gross margins are so strong and they're already pretty darn close to having positive earnings per share. Here's where it gets a little bit sticky for projections here, guys. So when you look at Yahoo has them growing 38% over the next 5 years. And then Stock Analysis has them growing around 20% over the next few years. So this is a tough one here. Now, when we look at the average, and I plugged in some of the numbers here, guys, when we look at the average, their average revenue growth has been 76%. Okay, so guys, in this one, it is really hard. There's just so many wild cards here to really project out a fair value for the company. We could do everything from grow their margins because their gross margins are so strong to growing their revenue growth at a high rate and keeping it elevated. I'm personally going to do a 35% growth rate from year 1 through 3. They've been averaging about 80% growth rate so let's just slash that in half and say through a contraction period here, we're going to see a drastic pullback in their growth rate. We're going to knock it down to 35%. From year 3 through 6, we'll keep it right around 20%. And then from 6 through 10, we're going to come down to high single-digit revenue growth. We're adding some share dilution, stating that probably early on we're going to have to see some capital raised due to the fact that cash is coming down. They're still at a burn rate, and they're investing more in another side of their business. So for me, guys, I'm personally going to build a decent amount of increased shares, around 7% for the next 10 years compounding. So that's going to add a pretty good amount of shares to the market. I require a 12% rate of return. And when we push that through, it looks like it could be between an $8 to $10 stock by 2030 with a fair price around $5 a share. So to me, guys, this is at an interesting point here, especially when we start thinking that it could dip back below $4 once again. Well, maybe they can do closer to 40% revenue over the next 3 years and closer to 25% revenue years following. And if I move those around, I get closer to a $10 price target. The other thing is, guys, I'm using a multiple of 12 from EV to EBITDA. I can bump that up as well to a 15, and then you're looking at a $12.55 stock. Definitely the growth aspect has been phenomenal, as we saw through both their subscription base and their top line revenue growth. Obviously, guys, the concern is when are they going to be profitable? And I think I was pretty fair in my estimates that it's probably going to be until 2025 before we start seeing them turn a profit. So, as always, guys, appreciate your time. Thank you so much for spending it with me, and we will see you next time, investors. Peace.